Have you ever wondered what magic makes your big purchases shrink into smaller, manageable monthly payments? Welcome to the world of credit card EMI. Let's start with what EMI stands for. It's an abbreviation for equated monthly installment. It might sound like a mouthful, but it's a fairly simple concept. Picture this. Instead of paying a hefty amount all at once, you get to divide the cost into monthly portions that are easier on your wallet. Now, that's what we call financial wizardry. But how exactly does this sorcery work? Well, when you opt for EMI on a credit card purchase, your bank pays the full amount to the merchant. You, in turn, agree to pay back the bank in smaller monthly installments, hence the term equated monthly installments. EMI is not just about breaking down large expenses, it's also about flexibility and convenience. It gives you the power to manage your finances better and the freedom to make those big-ticket purchases without feeling the pinch. Want that latest smartphone? Or maybe a brand new flat-screen TV? With EMI, you can have it all without burning a hole in your pocket. Not to mention, using EMI can also help improve your credit score. Provided you make your payments on time, it's a win-win situation, really. You get what you want when you want it, and you also get to build a strong credit profile in the process. The benefits of EMI are clear as day: manageable payments, financial flexibility, and potential credit score improvement. But as with all magic, there's a trick to it. It's not just about waving your credit card and poof, your purchase is magically divided into installments. So, EMI is your magic wand that makes your big-ticket purchases affordable. But how does this magic work? Let's unravel the mystery. So you swipe your card, choose EMI, and voila, your purchase is now bite-sized. But what happens behind the scenes? Let's take a peek into the mechanics of credit card EMI. Imagine you've just made a big-ticket purchase. You choose to pay via EMI, and that's when the cogwheels start turning. Firstly, your bank pays the entire amount to the merchant upfront. Now, it's time for you to repay the bank. This is where the term of your EMI comes into play. The tenure of your EMI can range from 3 months to 2 years. The longer the tenure, the smaller the monthly installment, but the higher the interest you end up paying. Speaking of interest, it's an essential part of the EMI equation. The interest rate is usually set by the bank and can vary from card to card. The interest is calculated on the outstanding balance, meaning as you keep paying off your EMI, the interest component in your monthly installment reduces. But remember, there's no such thing as a free lunch. Along with the interest, there may be processing fees involved. These fees are usually a small percentage of your purchase amount, and they're charged when you opt for EMI. Now, what if you land a windfall and decide to pay off your EMI early? Well, some banks might charge you a pre-closure fee for paying off your loan ahead of schedule. This fee is usually a small percentage of the outstanding amount. It's also important to know that your credit limit gets reduced by the amount of the purchase when you choose EMI. As you pay off your EMI, your credit limit gets restored gradually. So in essence, when you opt for credit card EMI, you're taking a mini loan from your bank, which you repay over an agreed period with interest. And for this convenience, you might have to bear some extra charges. Understanding these mechanics is crucial to make the most of your credit card EMI. But is everyone eligible for this? Can everyone wave the magic wand of EMI, or is there a secret club? Let's delve into the world of credit card EMI eligibility. You see, not everyone can avail the EMI option on their credit card. There are certain factors that determine whether you're eligible or not. Your credit card company may even have specific policies in place that influence your eligibility. The first factor that comes into play is your credit score. The credit score is a numerical representation of your creditworthiness based on your credit history. It ranges from 300 to 850. With the higher the score, the better your chances of getting approved for EMI. A score of 700 and above is generally considered good. Next, we have your credit limit. The credit limit is the maximum amount that you can borrow using your credit card. If the purchase amount is more than your available credit limit, you won't be able to convert it into EMI. So it's always a good idea to keep a check on your credit limit before making any big-ticket purchases. Then comes the policies of your card issuer. Each card issuer has its own set of rules and regulations when it comes to EMI conversion. Some may allow EMI conversion only on certain types of purchases or above a specific amount. Others may require you to have been a cardholder for a certain period of time before you can avail the EMI option. So, it's important to familiarize yourself with your card issuer's EMI policies. Lastly, your repayment history also plays a role. If you have a habit of missing your credit card payments or paying late, your card issuer might not allow you to convert your purchases into EMI. They need to be confident that you can make your EMI payments on time. So while EMI is a useful tool, it's not for everyone. But what if you're eligible and want to convert a purchase into EMI? Let's explore that in the next scene. So you've made a big purchase and now you want to convert it into EMI. But how? Well, let's take a deep dive into the process. Converting credit card purchases into equated monthly installments or EMIs is a convenient way to manage your finances, especially when you've made a hefty purchase. There are two ways to go about this. First, you can do it at the point of sale. And second, you can convert a transaction into EMI after the purchase. Let's start with the point of sale. When you're about to swipe your card for a big purchase, simply ask the merchant if they offer EMI conversion. If they do, they'll enter the transaction as an EMI purchase, and voila, you're done. The total amount will be divided into equal monthly installments over a period of time, typically ranging from 3 months to 2 years. Now, what if you already made the purchase without opting for EMI at the point of sale? No worries, you can still convert this into EMI. Log into your online banking or credit card account. Look for a section that says Convert to EMI or something similar. Select the purchase you want to convert, choose the tenure of your EMI, and confirm the transaction. Remember, the tenure you choose will determine your monthly installment. A shorter tenure means higher EMIs but less interest, while a longer tenure means lower EMIs but more interest. So choose wisely based on your repayment capacity. However, keep in mind that not all purchases can be converted into EMIs. Your bank will have a minimum transaction amount for EMI conversion. Generally, this limit is around 2,000 to 3,000 rupees, but it varies from bank to bank. Also, not all banks offer post-purchase EMI conversion, so it's always a good idea to check with your bank about their EMI policies before making a big purchase. With these steps, you can easily convert your purchases into EMIs, but remember, every magic comes with a price. So always be aware of the interest rates and processing fees associated with your EMI conversion. EMI is a powerful tool, but with great power comes great responsibility. A mantra worth remembering, especially when delving into the world of credit card equated monthly installments or EMIs. Now let's dive into some of the potential pitfalls of using EMI. First, there's the risk of overspending. It's easy to fall into the trap of thinking, oh, I can afford this expensive item because I can pay for it in small, manageable chunks. But remember, these small chunks add up, and before you know it, you might find yourself swimming in a sea of debt. Next, let's talk about the impact on your credit score. Your credit score is like your financial identity. Each time you opt for EMI, it's recorded in your credit history. If you regularly miss your EMI payments, it signals to lenders that you're not reliable when it comes to repaying your debts, which can seriously dent your credit score. And a low credit score can make it harder for you to get loans or other credit cards in the future. Then there's the cost of interest. Yes, EMIs make large purchases more affordable by spreading the cost over several months. But remember, nothing in life is free. The convenience of EMIs comes at a cost. The interest charged by the credit card company. Over time, this interest can add up to a substantial amount, making your purchase a lot more expensive than you initially thought. So, how do you use EMI responsibly? Start by setting a budget and sticking to it. Avoid impulse purchases and only opt for EMI for necessary big-ticket items. Make sure you understand the interest rate and calculate the total cost before you commit. And most importantly, always pay your EMIs on time. So use the magic of EMI wisely, because as they say, with magic comes a price. And in the world of credit card EMIs, this price can be quite steep if you're not careful. So tread wisely, spend responsibly, and keep your financial health in check.